There's something called the VA assumption loan, where essentially you are assuming the loan of the seller. So whatever interest rate they bought the home at, and whatever the terms were when they purchased that home, you will assume those terms, that interest rate, and the remaining mortgage balance. So that is good to know, especially in these markets now, where the interest rates are kind of high when you compare it to the interest rate a couple of years ago when it was much lower. Just another way to buy a home with a much lower interest rate. I personally did it here in Hawaii. So it's just something for you to know. It's not very popular. Not many people know about it. I didn't know about it. I just read about it on Reddit, and I kind of asked a realtor about it, and it kind of worked out. The main pro is obviously is that you're assuming the lower interest rate, so that's nice, and also your mortgage term length is much less now because the original buyer has been paying down the mortgage. So let's say it's a 30-year loan and they've been living in this property for 8 years. When you assume that loan, now you have 22 years left of that loan instead of 30 years. So now your mortgage payments are going more towards the principal versus towards the interest, if you know amortization of mortgages. The biggest con is that one, it's not as available. Not all homes have the assumption loan option. And the second thing is that you may have to come up with a bigger down payment. So definitely Google it and just do some more research for it.